Welcome to our series of educational videos on technical analysis. This is part 5, Elliot Wave analysis. I'm Michael Gable, Managing Director of Fairmont Equities. Please ensure you are familiar with our disclaimer in that any advice is general only. The first part was an introduction, part 2 we looked at charting patterns, and then in part 3 we looked at candlestick reversals. In part 4 I covered a few indicators that can be used to help your trading, and in this part I'll go through the basics of Elliot Wave with some practical examples. Finally, in part 6 I'll show you how we combine both technical and fundamental analysis. For those not familiar with us, Fairmont Equities is a share advisory firm helping clients achieve higher returns from their share portfolios by combining both fundamental and technical analysis. You may have seen some of our other commentary in the specialist media, such as the Financial Review, and I regularly provide commentary on the Sky News Business Channel and CNBC. We have previously looked at the way pricing patterns can give us an insight into how a stock is trading. Elliot Wave goes a step further and breaks down each movement into some observable waves. The key points of Elliot Wave are this. Firstly, there is an action followed by a reaction. There's 5 waves in the direction of the main trend, followed by 3 corrective waves, what we refer to as a 5-3 move. This 5-3 move becomes 2 subdivisions of the next higher 5-3 wave. In other words, you get waves within waves. The underlying 5-3 patterns remain constant, even though the time span of each may vary. So a basic pattern is made up of 8 waves. You have 5 going up and then 3 going back down. And we label this 1, 2, 3, 4, 5 and then A, B, C. Within the 5 waves going in the direction of the trend, waves 1, 3 and 5 are impulsive and waves 2 and 4 are corrective waves. And then waves A, B and C correct against the main trend. With the rules of Elliot Wave, wave 2 cannot exceed the start of wave 1, wave 3 cannot be the shortest, and wave 4 cannot overlap the price territory of wave 1, except when it's in a triangle. So let's have a look at a practical example. So this is a weekly chart of Telstra. In this instance, the direction of the trend is down. So we could see 5 waves with Telstra here. So we start off here. So basically wave 1, 2 against the trend, 3, 4 against the trend, and then 5. So that's our 5 waves on the way down. So firstly we have wave 1. So this is the first part of the wave, and later on it gets corrected by wave 2, which is here. So wave 2 would retrace much of wave 1, but never 100%. So if wave 1 started up here and headed down, we could see that wave 2 finishes here and doesn't quite overlap the start of wave 1. And there's usually low volume. So if the direction of the trend is down and this is correcting against the trend, we'd expect lower volume to go against the trend. And then we move on to wave 3, which is an impulsive wave, and that's quite clear in this example. So we could see that wave 3, in this instance with Telstra, it went from around 640 down to about 520 in the space of only a couple of months. So very impulsive. It's usually the largest. It doesn't have to be the largest, it just can't be the smallest, but it is usually the largest and the most powerful wave. So there's strong confidence now in this new direction on the downside, and this wave has the most volume and price movement. And wave 3s are often likely to extend, so it can sometimes go a little bit longer than you think. We then get wave 4, which is very corrective. So they tend to be range bound and they don't extend very far. So in this instance, wave 3 ended here, and we could see with wave 4 it doesn't really make much progress, and we could see it being very range bound. And once again, it doesn't overlap the end of wave 1 here and the start of wave 2, so we could see there is a definite gap. And then finally we get wave 5. So this is the final movement down, ending this 5-wave movement in this direction. So in this case we saw Telstra go from about 660 when we started at wave 1, and by the time we're finished it's trading under 480, so a fairly decent movement on the way down there. So the 5 waves head in the direction of the trend. When we talk about wave 3, we're looking at a corrective movement against that. So with a 3-wave corrective movement, we start off with wave A. So this is where the market believes that this wave is a correction of the previous trend, and often it can be divided into 5 smaller waves itself. And then it comes back with wave B, and this makes people believing that the stock's heading in the wrong direction. And then in wave C, volume starts to pick up again. Wave C is in the direction of wave A. So we'll just show some practical examples. So this is a weekly chart of Premier Investments, and I've circled 3-wave declines. So clearly this stock is in an uptrend, and if we're having a 3-wave movement, also known as an ABC correction, then we are correcting against the uptrend. In other words, we're moving in the opposite direction momentarily. So the trend is up for Premier Investments, and we can see here's a little 3-wave decline against the uptrend, then it resumes the movement up, another 3-wave decline, keeps heading up, and here's a very more obvious 3-wave decline against the uptrend. So they're the basics of Elliot Wave in terms of your 5 waves in the direction of the trend and your 3 waves against the trend as you correct. So coming up next in part 6, we'll explain how to combine both fundamental and technical analysis to improve your trading results. Remember, if you're not viewing this video on the Fairmont Equities website, make sure you do pay us a visit where you can subscribe to the research and see our real stock picks in action. There's also a free blog page that does get updated regularly with articles and videos.